TRS, there's two kinds of retirement plans. Your defined benefit, which is your TRS pension, and defined contribution plans, which I'll be referring to as DC plans. And we're going to go into more depth on each of these. Your TRS plan is really a dying breed. You don't really see this much anymore in the employer world, and it's even starting to disappear in the public sector as well. So we're very fortunate to have defined benefit plans here, and they're based on a formula. And if you're not familiar with it, we take your years of creditable service, we multiply that by 2%, and then we look at your whole TRS career and we say, where are the highest consecutive 24 months of pay? And that's what we use as your high average salary within the formula. And we multiply that all together to get your total. One wonderful feature for you with the defined benefit plan is that all the investment risk is carried by TRS. You don't have to worry about the ups and downs of the stock market. We obviously do at TRS, but in terms of your situation, it's all solely based on that formula that simply looks at how long you've worked, your years of service, and your high average salary. All the investments are made by professionals who make recommendations to our TRS board. You may be curious how we've allocated our funds among the different assets at TRS. I just got a number off the press as of 5/31 of this year. We're at about $91 billion in total assets. And of that, 69.7% is invested in the stock market. 82% of that money is managed in-house and placed into 16 mirrored indexed funds that are very similar to, but not exactly the same, as indices like the S&P 500, S&P 600. And we have in-house experts who tweak that investment mix, pulling certain stocks in and out of that basket such that we beat the market performance. 18% of the stocks we buy come through recommendations from external sources. We have people coming into TRS from all over the world. They fly in, and then we always know that investment people are coming in because they have the big stretch limos coming into the front of TRS. But they're here to tell their story and get recommendations from our investment experts to become part of our portfolio. Bonds and treasury notes are 28% of our total assets. Cash, property, and receivables is 2.1%. And lastly, we have a relatively new asset class, and those are alternative investments. That's 0.2%. Alternative investments with us, for the most part, is what we call private equities. That would be companies that are not publicly traded. I'm sure you've all heard and enjoyed Chick-fil-A sandwiches. Chick-fil-A is a private equity company. Cargill is a huge agricultural conglomerate. They make food products, industrial products. They're also private equity. And that's been doing rather well from us. So in the end, how much will you need to retire? The generally accepted income replacement ratio in order to maintain your standard of living is 80% of your pre-retirement income. So the idea is that when you add TRS, your Social Security, if you're going to get it from your school system, and your personal savings, such as through your defined contribution plan, you'd want to at least cross that 80% threshold. Now, I'm painting with a very broad brushstroke. Everyone's going to be a little bit different or a lot different depending on your retirement goals. But if you want to at least have a starting point in answering that question, how much am I going to need? Generally, we're telling folks 80% in order to maintain your standard of living. And under the formula, you can go up to 40 years and get 80%. But how many of you are going to, do the full 40 years? Probably not that many. So where's the additional money going to come from in order to get to or exceed that threshold amount? And one of the most convenient ways to do that and save additional retirement income is to join your school system's defined contribution plan. They come in two flavors. I think most of you are in 403B. There's also a 457B. They are, however, limited by the IRS in terms of how much you can contribute. For 2023, the maximum allowable contribution amount was $22,500 a year. We can do questions. I didn't mention it, but questions we can do at the end. And then we'll be happy to do them in the lobby as well. So the maximum contribution is $22,500. If you're 50 plus, there's a catch-up provision where you can put in an extra $7,500. So for those of you so inclined, you can put up to $30,000 a year into a defined contribution plan. Now, you also, in these plans, decide where you want to invest the money. And that's going to be based in part on your risk tolerance. Risk tolerance refers to the amount of loss an investor is prepared to handle while making investment decisions. Generally, investors are categorized into three different categories. That would be aggressive, moderate, or conservative. And it's influenced by a number of factors. How much time before you need the money? The more time you have, the more risk tolerant typically you are. How much money are you going to need to reach your goals? How old are you? If you're a younger investor, you have more time to handle market fluctuations. How much money is in your portfolio? The larger portfolios can handle more risk. And then, of course, last but not least, how comfortable are you with risk? You may be a very rich individual, but not willing to take on too much risk. And then through your school system's DC plan, you also have access to these licensed financial advisors who will have a lot of experience working with teachers. They understand the benefit formula, they understand service purchases, and then the nuances involved with TRS. So they're a great source for you to go to, and I'm sure many of you have, but they don't charge you anything for those services. So it's a wonderful thing to take advantage of. Now, but unlike your pension, with your defined contribution plan, you assume all the investment risk. It's on you to handle the stress of the ups and downs of the stock and bond market. You're also going to select vendors that are offered by your school system. So it might be, you don't have that freedom to go out and do it on your own, but the schools will offer them to you. We'll look at that in more depth. And these licensed advisors will come to your school, and they'll be happy to meet with you when you have free time. So take advantage of that. And they have wonderful, sophisticated software tools that will look at a timeline and your savings, all the income coming in, and then the cash going out, and tell you along your lifeline, your life expectancy, where there may be income gaps. They'll look at things like Social Security, healthcare expenses rising, all the variables we typically have in life, and they can help you identify where you may have a shortfall and what you could do now to avoid having that problem later. So really the bottom line when you look at all these factors is that like your TRS pension, there's really no material concern with fraud that we're focusing on today. But are there areas of concern that you should be aware of? And that is a definite yes. So let's look at what those areas are. You've got vendor fees, and we'll see those vary quite widely, particularly within school systems here in Georgia. There are surrender charges. We'll look at what those are. And then you're faced many times with choosing the best vendor that your school system offers. So let's look at each of these three in a little more depth. Fees and more fees. They can vary greatly from one vendor to another, from one investment fund to another. And, you always hear that, watch out for high fees. But my question always was, well, what is a high fee? Give me some relative points so I can make some judgments and know whether or not I'm being charged an inordinate amount. And so I did a little research, and I've got some numbers for you. Fees can be assessed for a wide variety of services. There are brokerage fees, advisor fees, record-keeping or custodial fees, general administrative fees, and account transfer or closure fees. According to a 2022 Government Accountability Office study, investment fees within 403Bs ranged from 0.01% to 2.37%. So in other words, expensive 403B investments cost 237 times more than your lower cost investment alternatives. So, talk about an expansive range. In a different study done by Aon Hewitt Consulting, they found typical 403B fees to be 2.25% for variable annuities, 1.15% for fixed annuities, and 0.97% for mutual funds. So you may, if you have choice within your 403B mix, you may want to focus in more on what mutual funds are being offered to avoid some of the higher fees. And, maybe from year to year, the higher fees may not seem so detrimental, but there have been a number of studies showing just how much impact higher fees can have. And I read one study where over a 40-year investment horizon, if you were subject to higher fees versus the lower fees over that time range, at the very end, you had 20% less in your portfolio. And can be a huge amount. So it's really something that needs to be considered and acted upon. All right, now there is within Georgia, I'm going to make you aware of a special consortium for 403B's school systems, it's a new and I think nice thing. And you could even bring it up with your HR folks if you so desire. Right now, there are about 9 counties in this consortium. I know Bibb County just joined it. It's called the Southern Education Retirement Consortium, where 403Bs are nice and low. Right now, they're only paying 0.38%. And as it grows and they accumulate more funds, that fee will lessen. I recall him saying at about $150 million in funds, which they're approaching, the fees will be down to 0.12%. And that's extraordinarily low compared to so many funds that are 2% plus in terms of fees. So if you want more information to follow up, I do have a person's name and phone number I can give you for that, because they do want to grow here within Georgia. So let's talk about surrender charges. I mean, what is a surrender charge? I'm sure any of you who've taken money out of your 403B, you may be familiar with this. It's a fee that you pay to take money out of your 403B. And this fee applies if the withdrawal is made during what's called the surrender period. And the surrender period within Georgia school systems, I found ranged anywhere from 5 years all the way up to a 15-year surrender period. Not all 403B vendors charge a surrender charge, but many of them do. So, and how much is a typical charge? For annuities, the surrender fee often starts at 5% to 15%. So if you're taking, say, 15% out of your defined contribution plan, they may withhold 15% of that as a fee, particularly if you're pulling money out in that first year after you create the fund. Usually what you see is that every year you hold that account, the surrender fee drops by 1%. So after 15 years, in this scenario, you would no longer have any fee to pull money out. So you may want to look at, how long is the surrender period in the investments you're making. The other thing that does make sense is that you would not take any money out until your particular surrender period has expired, because at that point, there would be no fees associated with making a withdrawal. Some of these funds do allow you to take out a relatively smaller amount each year without a surrender charge, but it's a wide variety of cases, so I can't give you any sort of average. It's the sort of thing you have to ask your vendor rep about to find out exactly what your fee or surrender charge structure is. Okay, choosing the best vendors from your school system. Like my father always taught me, the best predictor of future behavior is past behavior. And certainly my preference in selecting a vendor would be to study and compare how their funds have performed in the past and what the trends are. You can also compare how vendors respond to certain questions. For example, does the vendor make more money for selling me one product or over another? That's a red flag. Do you receive a commission, bonus, or prize for you investing with them? For insurance products, and this really caught me as a surprise, commissions could be as high as 70% of the first year's premium. So 70 cents on the dollar for that whole first year isn't going in your investment portfolio, it's going into the person who sold it to you. And then each year thereafter, 3 to 5% of the premium is commission and does not go into your portfolio. Or it could be that they win a vacation. I've seen that out there. And I can just hear the person saying, hey, I'm going to Disney World, and by the way, you're paying for it. It's a good deal for them, but not so much for you. And research has shown that when commissions are involved, your typical or many of these financial advisors will recommend those investment instruments that provide them with a commission, whether or not that investment is in your financial best interest. Because those folks have bills to pay too, and they tend to put themselves in front of you and your financial needs. Okay, other things you should be aware of, and this I found very surprising. Within the school systems, the majority of Georgia's school systems do not use a formal vetting process to screen the vendors that they offer to you at school. You might assume the opposite, but when I talk to all the people who work quite a bit with school systems, I found that not to be the case. Now, many of them, however, are formal, and we'll talk about that too. They use what's called an RFP, or request for proposal, in vetting these DC vendors. It's a formal document sent to the vendors who wish to do business with your school system. The system asks the vendor for written answers to numerous questions. The answers are scored by a whole team of folks usually, or the scorer could be the school system's designee, like a consultant. And then the vendor with the highest score is awarded the contract. And this kind of vetting process is a good system to make sure that you're making good decisions about what vendors are being used. You know, and after interviewing a number of these 403B vendors, that it's clear really only a minority use this sort of RFP process. And one employer that does is the University System of Georgia. They do have a consultant that goes through the RFPs and helps them make a decision. And they use the same 403B vendor for all 26 of their institutes of higher education. And then that consultant is also there from day to day to monitor what's going on within the system. So that's the sort of thing I'd be comfortable with. Now, when it comes to employee benefits, you know, would you offer your teachers 7 or more different dental plans? Can you imagine having to choose that for one of your benefits? And that's the case we found for many of the counties offering these defined contribution plans. They have from 7 to 12 that you have to choose from. And why do these school systems offer so many 403B vendors? Well, perhaps the concept they believe in is the more the merrier. Well, that philosophy, at least in the defined contribution world, does lead to higher fees. You know, when one vendor is selected, they can discount their fees knowing that they're going to get a higher volume of business in that county from the school system. Also, when you have a single vendor system, the advisors who are working with that school system have a lot more time they can devote to building relationships with you rather than competing with other vendors for sales. More things you should be aware of. Each school system does choose their own DC vendor. Quite often it's by the school superintendent, or it might even be the human resources director. The plans that are offered within the public school systems are not subject to ERISA. I'll talk about that for a moment. But it, in the end, means there's no set standards on monitoring the vendors. ERISA stands for the Employee Retirement Income Security Act. It started in 1974. It's a federal law that sets minimum standards for most voluntarily established retirement and health plans in the private industry, with the ultimate goal of providing protection for people in these plans. Now, your defined contribution plans are not bound by ERISA law. You're within the public sector. Now, that does offer some advantages to the plan sponsor. It gives the school districts more flexibility in plan structure, fewer reporting and disclosure requirements, and less strict fiduciary requirements. Non-ERISA plans may also be exempt from filing and auditing requirements. However, being non-ERISA, there is a potential problem because there are no minimum standards to protect you, the investor. So you may have to do more homework on whether or not you're being offered a quality plan. Another thing you should be aware of, a source where you can do some homework and get good answers on the quality of the plans and brokers you're dealing with. It's through an organization called FINRA, and FINRA stands for the Financial Industry Regulatory Authority, and you can see up here their website and 800 number. It's a private organization that acts as a self-regulatory organization. It's non-governmental, and it regulates member brokerage firms and exchange markets. The government agency which acts as the ultimate regulator of the securities industry, including FINRA, is the SEC, and you will be hearing about from them in the next segment. Now, they do have a wonderful tool that I played with. It's called the Broker Check tool. You'll get data on individual brokers and brokerage firms. It tells you if a broker is registered to sell securities and offer advice. It also provides a broker's employment history and licenses, and also includes any regulatory actions, complaints, or fines against brokers. So if you're so inclined, do take advantage of those tools. So there are other forms of retirement income we'll take a brief look at, and that is investing on your own outside of the defined contribution plans, and we'll also take a little bit deeper look into Social Security and things that I think are important for you to know. Now, if you're investing on your own outside of the defined contribution plan, I mean, you can always go solo, if I can use that term, with your money and invest in anything you want, right? Maybe you have a relative who wants to start a used car lot or open a new burger stand, right? Well, you know, go for it if you're so inclined. Of course, if you go this route, it's on you not only to invest your money, but also a higher percentage of your time, you know, studying the merits of those sorts of investments. And do you have the time and expertise to take this kind of risk? I mean, most teachers do not. You'd likely face advisors who are working on commissions, and you do not have the benefit of pre-tax contributions like you do with your defined contribution plan. Being on your own gives you the ultimate freedom in making choices, but with that freedom becomes, you know, you're more exposed to fraud when you have that sort of freedom. And there are a myriad of scams out there, which the SEC will touch on in the next segment. Let's move on and talk about three-legged and four-legged stools. Okay, the concept here is with a three-legged stool, you know, it's the formation of a secure retirement in that each leg will support your secure retirement, and it takes all three legs in order to do that. Obviously, if one or two legs is missing, that stool will fall over. And one leg would be represented by TRS. One leg would be your personal savings, in this case, your defined contribution plan, bank savings, et cetera. And then Social Security for those of you working for a school system that does take it out. For many teachers covered by Social Security at full retirement age, they can expect Social Security to replace about 33% of their income. So you can see it's a rather large component of having a secure retirement. There's a lot of press about the Social Security Trust Fund drying out, running out of funds. According to a 2021 annual report, Social Security can pay scheduled benefits until 2033, and then would only be able to pay 76% of scheduled benefits until the fund's depleted. Now, it's unlikely the federal government would not step in and make adjustments to correct this. There are a lot of different things they could tweak. They could, for example, change age requirements. They could increase payroll taxes. You know, and these are all things they've done before. You know, payroll tax way back when used to be 2%, then it was 4%, now it's over 6%. So there are a lot of different ways that, you know, they can make adjustments. And speaking of lower reserves on the whole, U.S. workers have had extremely low savings over the last decade, with recessions and lagging salaries making it tough to put money aside. If you look at the last 10 years, the U.S. savings rate is 3.5%, while financial advisors recommend that you set aside 20% for retirement. So you can see that's a huge disparity between what we're actually doing and what's recommended. So with all this being said, what if your legs aren't enough for a secure retirement? And that's where this new concept of a fourth leg comes in. And we're seeing a lot more retirees add that fourth leg and go back and continue to work to some degree in retirement. Now, for many of us in retirement, that may give us more of a sense of value later in life. You could certainly focus on doing work that you enjoy, but many of us prefer not having to work, right? That's the whole idea of retirement. So if you don't want four legs under your stool, what can you do now to avoid that? Well, let's first look at what happens if your school system does not deduct Social Security. And one thing you can do, start a defined contribution plan and put into your defined contribution plan the same amount of money that would have come out anyways for Social Security. So why not put in at least that 6% that all the other teachers are paying anyways if they're in a county that does deduct it? Of course, you can put in a good bit more than that too. And as an FYI, here in Georgia, a full 40% of our school systems do not participate in Social Security. Do we have any here today where your school system did not participate? Well, probably about, 15, 20% of you did not. I think it's Cobb County, right? Did not, and maybe Marietta City. Cobb does. I know DeKalb doesn't. Marietta does not. It was back, I think it was the 1980s, that under Jimmy Carter, school systems had the option of either staying in or leaving, because I'm sure you're all well aware, maybe not, that not only are you putting in the 6+%, but your school system is matching that. So if they don't have to make that matching contributions, they save, quite a bit of payroll expense. But then what can you do about it to recoup in some way, shape, or form those funds not being available in your retirement? Now, you do need a minimum of 10 years to get a benefit from Social Security. And each of those 10 years and any additional years have to be at a level that's considered substantial earnings in order for it to count. It can't be, part-time work, say within the fast food industry, for example. It'd have to be a quote-unquote real sort of position. 30 years ago, substantial earnings was $10,725 a year. For 2023, in order for earnings to be substantial, it has to be $29,700. Can anyone guess what substantial earnings was 50 years ago in 1973? Any takers? It was $2,700 back in 1973. So you can certainly see the effects of inflation. All right, now I'm sure a lot of you, even though your current school system didn't take out Social Security, you likely have years where you were contributing and you have 10 plus. So what happens then? Well, there are a couple federal laws you need to be aware of. And as I travel the state, it's not the sort of thing that a lot of teachers are aware of or really understand. So I thought it would be useful to take a few minutes to talk about the WEP and the GPO. WEP stands for Windfall Elimination Provision, and the GPO stands for the Government Pension Offset. You can collect Social Security benefits in one of two ways, either through your work record or through a spouse's work record, but you can't collect from both of them at the same time. So let's look at the WEP. And this would be for people who have under 10 years, you're not going to get anything. Once you have 20 to 30 years, you're going to have a less of a reduction in the penalty. So if you have under 20 years, you're going to have the maximum penalty, and that's currently, and it changes each year, $557 less per month. So that would be the most. And it can't exceed half of your Social Security benefit. The penalty can't. So once you hit 21 years, for example, the penalty goes from the $557 to a lesser amount. Actually, it's $55.70 less of a penalty per month for each year you have over 20. So you can see that once you hit that 30 years, that penalty will be eliminated, and it'll be a way to work around the windfall elimination provision. All right. And let's go to the GPO. Normally you get half of your spouse's benefit, but if you're subject to the GPO, for every $3 you get from TRS, you get $2 less from Social Security. And the TRS benefit on average is so much larger than the spousal benefit that most often what we see is that the spouse's benefit is totally eliminated, and you're not going to be eligible to get anything through the spousal benefit. And let me give you a typical example. The average TRS benefit is about $3,500 a month, and while the average Social Security spousal benefit in 2022 was $830. So in the average scenario, the reduction to your Social Security benefit would be $2,300. And what happens when you subtract 2,300 from 830? Do you have any math teachers here? You've got a negative number. It's zero. So the benefit is totally eliminated typically. If you're divorced, you can still, as long as you were married 10 years to that spouse, you're eligible for a spousal benefit. Okay, there are ways to get out of the WEP and GPO, and we already covered how you can do that with the WEP. If once you hit that 20 years, you start to reduce the penalty, and once you hit that 30th year, the penalty is totally wiped out, as long as those earnings, that you're covered under are substantial. And with the government pension offset, if your last 5 years of employment are under Social Security, and those last 5 years are also under TRS, you're going to be exempt from the government pension offset. So what that can mean for some of you, and we see it every now and then, is a teacher will switch from one county to another. Maybe the county next door does take out Social Security, and for their last 5 years under TRS, they're making contributions to Social Security, and then they're going to be entitled to the full spousal benefit, which is, as I mentioned, 1/2 of the worker's benefit. So be aware of that in case you're impacted by it. The last 5 years, if they're not under TRS, it won't count. So if you do them under the private sector, it's not going to get you an exemption from the government pension offset. All right, so when might there be exposure to fraud risk that is linked to your TRS benefit? And that would be in situations where you're getting a Plop distribution. And then there's also deceptive sales tactics out there that I'd like to make you aware of. It's actually a very real thing out there now that we're witnessing. So when you elect a Plop at retirement, it's only available for you to get when you're making your retirement application. You can't get a Plop and then continue to work. Also, you make that election right on the form, and you do that when you're within 6 months of retirement eligibility. And what does Plop stand for? Well, it means partial lump sum option plan, and it's a plan feature that lets you take a lump sum distribution of cash in lieu of a permanently reduced TRS benefit. The typical reduction is $7 to $10 less per month per $1,000 of Plop that you decide to take out. So for example, if you took out a $10,000 Plop, on average, you'd see a reduced benefit of anywhere from $70 to $100 per month. And since your benefit is being reduced, your COLA increases are going to be reduced as well. And that's another thing to consider when you're looking at these Plop distributions, because, you know, as long as we have CPI inflation, consumer price index inflation, our board shall award a 1.5% COLA on your benefit. So if you have a smaller benefit, the 1.5% increase will be proportionately smaller as well. If you do take a Plop, ultimately you'll have to pay normal state and federal taxes, you know, once you take possession of that money. If you're under age 55, you may be subject to an additional 10% penalty tax. You can defer those taxes by doing what's called a direct rollover. You could have the money sent without ever touching it. It goes directly to an IRA at your local bank. I'm sure your existing 403B plans would be happy to take a direct rollover. Then you're not paying those taxes until you actually take a distribution. If you want to learn more about that kind of scenario, we do have what's called a special tax notice form. It's on the TRS website, and it'll walk you through everything you'd want to know. So let's look at some Plop statistics here. Since the benefit's inception in fiscal year '05, we've had over 13,000 members who've elected to take a Plop distribution. On average, the Plop is $48,600 plus. And since inception, altogether, we've dispersed through Plops over $636 million. So it is a substantial sum. If you were to focus on the last 3 years, we have had 1,850 members take one, and a full 77% took possession of the full amount. So these people are putting the money to some use immediately. 23% did a full or partial rollover into another qualified retirement plan. So Plops, as you can see, are a very attractive monetary prize, especially for dishonest people hoping to get a chance to take some of that money. And this, I think, is where a lot of the exposure to fraud can come from, you know, that's related directly to your TRS benefit. It's a big red flag if you have any investment salespeople encouraging you to take a Plop investment and then turn around and invest that money through them. And I've seen this in the field, and I've seen investment salespeople talking to our members about, hey, you know, I think you should take a Plop, and this is what we can do with your money. Your TRS benefit's a guaranteed lifetime benefit. It'll never run out, and you have cost of living adjustments. There's no investment risk with TRS. So, you know, you'd be giving up guaranteed lifetime monthly benefits, and that's not a typical funding source for making an investment. Don't forget that if you do take a Plop, you're also lowering your COLA increases. You know, and I've heard some advisors say things like, I have a special investment strategy to provide you with a guaranteed net positive benefit. You know, they're saying that you invest through me, I will provide you with more money, more cash flow than you're giving up by taking this plot. And we, TRS, did an internal calculation to see just what would it take to recoup what you gave up with the plot. And we calculated that you'd need a return on investment of 11% per year, every year. And that kind of return on investment, over the long haul is simply not realistic. Too good to be true. Now, since plops are relatively expensive and impact your lifetime benefit, we do recommend you consider using a licensed financial advisor to see if a plop makes sense for you. A good place to start if you're looking for, I think, sound advice is with your school system's 403B or 457 vendor. They're familiar with working with teachers and how TRS works. But I've also heard scenarios, where a plop may make sense, even after, careful consideration by a licensed financial advisor. And it's good that a plop is there. I mean, you could, for example, and I've seen this done, you could retire high-interest credit card debt. I mean, credit cards, I see 25, 30% interest. It may be a good idea to pay off all or some of that prior to retirement. Some use it to help a grandchild get through college and cover those expenses. It could be a quasi form of life insurance. I've seen that. It could be an emergency savings fund to avoid using a credit card when you have unexpected expenses. So there are legitimate uses. Or, you may be in that situation where you just have more money than you need and know what to do with, right? Hallelujah, if that's your situation, right? And then, of course, unfortunately, there are dishonest salespeople and firms who have represented themselves as TRS. And we've seen this over the years, but even more so recently. We've had reports from members and employers about this. And in some cases, we've had to go through our Office of Attorney General to issue formal legal cease and desist orders. And when we've seen this increased activity of dishonest firms or folks, we've sent letters to employers describing the dishonest activity with the expectations that members would get informed as well. What are some of these tactics that we're seeing? Well, fake emails appearing to be from TRS. Marketing materials that appear to be from TRS. We've even seen sales presentations where they're using our exact same slides, representing themselves like they were, working for TRS. So don't be fooled. Their only concern is getting access to your money. And by the way, we will never invite you to have a free lunch to learn about investment opportunities. That is not one of our marketing strategies. So how do you avoid being a victim? Well, you can certainly verify where these emails are coming from. If you hold the cursor, wave it over the sender, you should get URL information. Our URL is trsga.com. You can always call us and ask about the legitimacy of, any kind of marketing that you get. There's our 800 number. It's also on the handouts we provided. Another good source would be to ask your HR department. They're very much aware of what activities that we're doing. When you call us, we'll be happy to check our outreach calendar, and we can let you know if that's an event that's being hosted by TRS or it's being hosted by some other party. And also you can visit our website and read about where we're going to be or how benefits actually work. Now, we do have a number of legitimate partnerships that you should be aware of, and that includes your school system's defined contribution plan vendors, speakers at officially TRS-hosted events, and we have a lot of wonderful working relationships with our TRS-covered employers. We maintain neutral positions in our interactions with DC plan vendors. We don't endorse any one vendor or suggest you use one over the other. So for that reason, the vendor must first arrange for an event through the school system. Once the school system gives the okay for the event, then the vendor may invite TRS to be on the agenda. You know, we're happy to provide this service to any defined contribution plan as long as they're in the systems, school systems, approved vendor list. You know, that vendor, in other words, has to have pre-tax payroll deduction set up so that our members can contribute into those companies. And we do over 300 events a year, and we get regular requests. I especially get calls directly from various defined contribution vendors, you know, wanting to know our schedule and where we're going to be through events that we set up. And they want to piggyback on what we're doing. And we don't grant those requests. It's got to come through the school system, inviting them onto their campus, and then we're happy to join. Now, if you want a joint workshop with TRS and your defined contribution vendor, just contact your HR department to have it set up. They'll know who to contact at TRS, and we'll be happy to come out. We have seminars all over the state, like this one, for all our member groups. We have mid-career seminars. We have teachers near retirement that we talk to. And then we have post-retirement. You know, our retirees have seminars as well. And we select speakers that are very well qualified. Quite often we're pulling PhDs from the University System of Georgia. And then we have experts who have full careers in relevant categories such as Social Security or estate planning, lawyers from law firms. And we also conduct regular surveys to make sure that we're providing you with information that's important to you. And if you're not able to attend in person, we often record the speakers and put that information on our website. So please visit the multimedia page, and you can view our podcasts and other videos. And last but not least, we work closely, pretty much on a daily basis, with our over 400 reporting employers. And that is most often the HR staff in the central office, but we also have great working relationships with principals and superintendents and other staff. And among other connections, we have a monthly reporting process where we're collecting teacher contributions, employer contributions, so that these school systems and you can participate in TRS. So we're managing balances and dealing with eligibility issues pretty much on a daily basis. And what do we do with those contributions? Those contributions, the 6% of your payroll, the 21% of payroll that comes from your employers, we invest that into the stock and bond market. And that return on investment that we get is representing 73% of the total funding that we use to pay our retirees each month. So the vast majority of funds that we use to pay our retirees is not supported by any taxpayers. And that's real important. If you're ever, approached by anyone with comments like TRS benefits are too rich and they can't be sustained, just tell them that 73% doesn't come from taxpayers. And that should change their way of thinking. So with that comment, I'll close the TRS segment.